Over the past 2 decades, China has developed into a global economic superpower. China is the only country in the world that has grown at such a rapid pace. However, what if I told you that all of China's growth was just a Ponzi scheme? ARK Invest CEO Cathie thinks that way when she compares the rapid rise of China to Japan's 30-year economic tragedy of the early 1990s. China is seeing the largest property bubble in its history, similar to the one that fueled Japan's GDP. Welcome to the Investing Wise Academy, a channel where aspiring millionaires and billionaires can learn how to invest wisely. In this video, we'll cover from top to bottom how the world is about to wake up to China's destined collapse. If you're new to our channel, please subscribe to see more videos like this. Let's get started. China's economy has developed significantly over the past 20 years, but a large percentage of that growth has come from real estate. Hundreds of cities have been added to the portfolios of property developers by borrowing money. Modern glass and steel residences, office buildings, and houses may be seen all across China's major cities. People started buying properties for the sole goal of raising their value. However, from a Chinese citizen viewpoint, house values have been rising steadily over the past few decades. This was partly due to China's tremendous population expansion, but the idea went much further. The majority of Chinese citizens could no longer afford a conventional house or apartment in cities like Beijing or Shanghai since property prices kept rising year after year. Buying a home close to the cities but far enough to avoid paying city prices would be the sensible move. As a result, a large number of citizens took this route. People began to seek out houses and apartments not in Chinese cities, but 10 to 15 kilometers out. As a result of the rising demand for housing near cities, prices began to rise, prompting individuals to move further away from urban areas. Developers anticipated that this growth would continue, so they constructed residences further and further out. If you drive an hour or two outside Beijing or Shanghai these days, you will notice something very strange. There are many modern buildings in excellent shape, but there is one problem: no one is there. These cities are known as ghost cities since they exist solely because speculators believe values will rise. This is evidence of China's expanding real estate bubble, which is a major engine of the country's economy. ORDOS New Town is the most well-known ghost town in China. It was thought that 1 million people would live in the city, but that number dropped to 300,000 and then to 100,000 in 2016. ORDOS New Town couldn't fill its empty houses until the best schools moved into the city. There are so many of these empty units that all of the space they take up could fit the whole country of Italy. Over the past 2 decades, the Chinese real estate market has grown to an estimated $50 trillion in value. In comparison to the GDP of the United States, it is 2 times as much as nearly 4 times as much. An investment management firm, Loomis Sales, estimates that 70% of China's total wealth is invested in real estate. It is not uncommon in China for residents to save money for decades in order to purchase a single house. Property prices near cities are so high in relation to income that individuals will be forced to rely on mortgages even after years of saving. This is exaggerated by the fact that rising housing prices cause citizens to fear missing out, ultimately compelling them to take out risky loans. 4 of the top 10 most expensive cities in which to buy a home are all in China. This level of appreciation is disturbing and will not last forever. This was evident during America's 2008 recession, and similar indicators are emerging in China. The Chinese real estate boom is already slowing significantly. Because the Chinese home market's prices continue to rise, property developers have done everything they can to extend their real estate portfolios as quickly as possible. Greed took center stage, as it does before any financial collapse, and developers were soon saddled with too much debt to bear. Evergrande, the pinnacle of Chinese real estate development, was among these developers. Evergrande is one of the world's largest real estate developers. Evergrande expanded its real estate holdings to over 565 million square meters of developing land by issuing corporate bonds to overseas investors. This was only possible because Evergrande borrowed more than $300 billion. Evergrande thrived as a result of its unprecedented access to money. Evergrande became the most valuable real estate corporation in the world in 2018. This bullish feeling soon began to wane as investors recognized Evergrande was in serious jeopardy. Due to a $260 million interest payment that Evergrande missed, credit agencies recently had to put the company in the debt default category. Since Evergrande's bond prices have dropped dramatically over the past few months, the credit outcry has been extreme. As a result of Evergrande's debt crisis, international bondholders are threatening legal action against the company. A large part of these difficulties stem from China's new President Xi Jinping's crackdown on the real estate market. President Xi is trying to make China less reliant on the real estate market by cutting down on real estate speculation. Xi's motto is that homes are places to live, not investments. China's economy is at risk because of what President Xi is doing. Even though Evergrande is a big fish, it is just one of many developers who are in default. The number of Chinese real estate developers is dwindling at an alarming rate. A recent example is the $101 million interest payment that Shimao, a Chinese developer, failed to pay. Another was at $175 million loans from OCEANWIDE Holdings that went bad. In the fourth quarter of 2021, a total of 484 corporations were delinquent on at least 3 commercial payments, according to a recent stock exchange. That's a lot of money. However, the situation is just growing worse and worse. Property developers in China are well aware that the market for Chinese real estate may not be the best right now. For the top 100 real estate development companies, December 2021's contracted sales were down 35%. According to Cathie, this is the first year of sales declines for development companies in over 2 decades.
Now, one other thing I'd like to focus on here is China. So much is going on in China that, again, the headlines are getting some of this, but within 1 week, a Bloomberg journalist, Sofia Horta Acosta, reported that all of this happened in Greater China this week. I'm going to just read you a few of these to give you a sense of the drama here. Evergrande suspends trading on the stock exchange. And the developer, Evergrande, was ordered, think about this, to demolish 39 illegal buildings because they didn't have the right permits. Can you imagine if that happened in the United States? The 100 largest developers in China reported that their contracted sales were down 35% in December, and for the year as a whole, they fell for the first time, Sophia says, in at least 5 years. I don't think I've ever seen them fall in the last 20 years. So real change. A few of the other developers went bust. Shimao, which was rated investment grade in November, defaulted on a trust product and rocked the credit market. And the central bank withdrew liquidity. A lot of people thought they were going to increase liquidity because they said they would. A China regulator vowed stability after stock market's rocky start, but they haven't done anything about it yet. And very interestingly, the yuan the RMB, the local currency, after a very strong year, held up, and I think it held up probably helped by the government, supported by the government. It is starting to weaken, quite a telltale sign. And one stock, Hurong, which had not traded since last March, opened this week and dropped 50%.
A slowdown in China's real estate market, according to the Federal Reserve, might have a negative impact on the U.S. economy. The Fed stated that stresses in China's real estate sector could strain the financial system, with possible spillovers to the United States. To back up this claim, the Fed cited China's government and local debt as a major concern. In the eyes of many economists, China's rapid GDP growth is an indicator of economic prosperity. However, there was an enormous debt bubble not just in China's real estate market, but in its whole economy, which powered most of the country's economic growth. Over the past 2 decades, the proportion of household debt to income and GDP in China has grown significantly. The growth in household debt is outpacing the growth in GDP. It is a fact that China's GDP has grown tremendously in recent years, but the country's debt balance has grown even faster. When it comes to China's total debt as a proportion of GDP, the country is nearly on par with those in more industrialized countries. Imagine a country like China with a debt-to-GDP ratio close to that of industrialized nations. Such as an overstretch will inevitably lead to bad outcomes. Also noted by the Fed was the risk that China's Communist Party's crackdowns could lead to a collapse in real estate values. This statement was made in response to China's strategy of imposing 3 red lines on the housing market. The 3 red dotted lines indicated the maximum amounts of debt that developers of real estate could take on: liability to asset ratios under 70%, net debt to equity ratios under 100%, and a cash to short-term debt ratio of 1 are the 3 conditions. Debt levels of companies that reach these benchmarks can be raised by 5% annually for each red line that is met. Even while such a policy makes sense, the government should have put it in place far sooner. According to Cathie, the CCP's new policies risk destroying the whole real estate industry. It's going to be difficult to get the developers back to the drawing board now that they've been stretched too thin. Chinese developers have broken at least 1 red line in the past year. This is a problem since property developers cannot simply reduce their responsibilities in this manner. Currently, many developers are seeking to satisfy their quotas only through the sale of homes. Evergrande and Kaisa Group Holdings are actively striving to sell their properties. Evergrande is attempting to sell the tower that houses its Hong Kong headquarters, the Evergrande Tower. Nonetheless, this property has not yet been sold. Kaisa Group Holdings has placed on the market 18 projects with a total square footage of 4.7 million square feet. Similarly to Evergrande, Kaisa has yet to sell any of these projects. The problem with all of these properties going on the market is that there are no buyers. This is due to the fact that all other real estate developers are also attempting to meet the 3 red line requirements. If there are no purchasers for all of the available property, Evergrande and Kaisa will be forced to cut their asking price. And when those prices are repeatedly dropped, the market will collapse. This was seen when Evergrande declared its intention to offer a 30% discount on all properties in order to raise funds. A 30% decline is significant, but it is not enough to entice purchasers. Evergrande's properties are just not selling quickly enough to cover the company's loan interest. This will harm China's formerly rapid GDP growth, which economists have admired for decades. Almost a third of China's economic output comes from property development. Consider the impact on the overall economy if this industry were to go bankrupt completely. A downturn in China's economy is not just a concern for Chinese individuals, says the Federal Reserve, but could affect people throughout the world. A decline in risk sentiment could put pressure on global financial markets, threaten global economic growth, and impact the United States, according to the Federal Reserve. To put it another way, a collapse in the Chinese real estate market would have far-reaching consequences for the global economy. China is the world's primary source of manufacturing for nearly any product you can think of. China accounted for nearly 28% of global industrial production in 2019. It's easy to believe that China is invincible in the face of a downturn of this magnitude. Even though Japan's real estate market collapsed in 1989, the current crisis in China bears many similarities to that in Japan. In the 1980s, Japan was widely regarded as the best example of how to expand an economy. Japan was predicted to someday overtake the United States as the world's most powerful nation. Japan's potential land value was found to be 4 times greater than that of the United States, according to news sources. In the 1980s, other countries envied Japan's rapid real GDP growth of 3.89% on average annually. However, a massive debt problem had erupted in Japan after several decades of strong economic expansion. Similar to what happened in China, Japanese companies borrowed a lot of money after the Ministry of Finance encouraged them to do so. The Finance Ministry also pushed for low interest rates, less government control, and domestic growth, all of which increased the amount of money in circulation by about 8 to 10% per year. The prices kept going up, and so did Japan's GDP. But even though Japan moved up the rankings very quickly, its economy fell even more quickly. The Japanese stock market has fallen over 60% to $15,900 by 1992. The Nikkei index fell another 45% over the next 2 decades, on top of the previous 60% collapse. Because equity prices did not recover for decades, this crash is known as the lost decades. China, according to Cathie, is in a similar scenario. China's real estate prices have reached new highs, fueled by the country's mounting debt issue. China's imminent downfall will have massive deflationary consequences. More precisely, China's faltering economy will send commodities down to new lows. An impending crash might have far-reaching consequences. Because commodities haven't plummeted much yet, Cathie is perplexed. Consumer confidence is usually associated with decreased commodity prices, but consumer confidence is still high, which could be misled by food prices.
Now, when China catches a cold, commodities usually catch pneumonia. And we're seeing this in a few commodities, iron ore prices and so forth, but it isn't quite clear-cut yet. And I was saying to our team this morning, how could this be happening and the economy not be falling apart and the consumer not getting restless there? Well, the consumer savings is 75% in real estate. But what I learned this morning, and it does make sense, one of our analysts, our newest genomics analyst, Pierce, worked in his lab as he was getting his PhD at Texas A&M with other Chinese students. In fact, he only worked with Chinese students. And he learned that a greeting in China, the equivalent of a hello, is basically, I hope you have enough to eat. And so pork prices and rice prices are critically important. And what do we see happening there? Pork prices are down, depending on the measure, 33 to 50%. Rice prices are fairly flat. And apparently that keeps the consumer happy. Now, I don't know, I think this property debacle is quite something, so we shall see.
Prices of properties are already beginning to crash as we speak. Chinese property sales fell by over 16% year over year in November, and new home prices fell by 0.3% month over month. A 0.3% month over month drop may not seem significant, but when annualized, it amounts to a 3.6% drop. Housing prices in China have slowed to levels not seen since the country's economic slump in 2015. Cathie explained in ARK Invest quarterly report how she believes China's GDP will decline significantly in the next 3 to 6 months. If they are correct, Cathie believes the market will focus more on the prospect of a US recession, the substantial slowdown in China and emerging market economies, and the possibility of a surprise reduction in inflation over the next 3 to 6 months. Some commodity prices have already turned red. Iron prices have dropped 35%, possibly as a result of China's real estate upheaval, while the Baltic Freight Dry Index has plunged more than 40%. DRAM prices have dropped 25%, and US lumber prices have dropped 33%. Even the WTI oil price, which was a major exception until recently, has dropped by 12%. By recognizing that China's economy is faltering, the Chinese Communist Party has taken measures to prevent a crash from taking place. A recent announcement by the People's Bank of China indicated a reduction in interest rates. Fed head Jerome Powell, on the other hand, is pushing for a rate hike right away. China's real estate market is in big trouble, and things are likely to keep getting worse as time goes on. Due to a tighter credit and stricter policies, S&P's rating agency thinks that home sales across the country will drop by 10% in 2022. No matter where you are, when you watch this video, you will be affected by that drop in some way. That's all for today. What are your thoughts on China? Do you agree with Cathie Wood? Join the conversation in the comments section below. Please click the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.